Welcome back to the deep dive. If you just glanced at the market news and your feeds this morning, wow, you probably saw a list of contradictions, right?
Absolutely. Stocks dropping despite great revenue, huge volume increases, but margin disappointment.
Yeah. And analysts upgrading some companies while, launching investigations into others. It's kind of chaos out there.
It is a phenomenal amount of information, and honestly, most of it feels like noise.
Right.
So our mission, as always, is to try and filter that information mountain. We are taking a deep dive into the 24-hour corporate news cycle leading up to this morning, October 30th, 2025.
And we're focusing on 8 specific baskets of stocks you've asked about.
Exactly. We're distilling the most critical earnings beats, the significant corporate actions, and those high-impact analyst calls that really matter right now.
We're trying to cut through the headlines, get to the essential why behind the numbers. Basically, this is your shortcut to understanding what moved the market overnight, what analysts are saying today, and what events are truly critical in the hours ahead.
Makes sense.
We have to start with fintech because today is, it's massive for that sector.
Let's jump straight into that high-stakes environment.
Yeah. Okay, let's unpack the fintech field. It's getting enormous investor attention right now. The immediate focus is absolutely on Coinbase, CIN.
Yep.
They're scheduled to report Q3 earnings after the market closes today, October 30th.
And this report is going to dictate the tone for the entire crypto-adjacent sector, The consensus going into the earnings call seems pretty bullish, anticipating high performance.
What are the numbers people are watching?
Well, we're looking for earnings per share, EPS, forecasted in a pretty tight range, like $1.06 to $1.13.
Yeah.
And revenue expected to land robustly between $1.7 billion and $1.8 billion.
Okay.
If they hit those numbers, it kind of confirms that the recent market momentum is sustainable for them, at least for now.
And we're seeing some of that momentum confirmed by analyst reactions to companies that already reported, right? Like SoFi.
Exactly. SoFi delivered an earnings beat just 2 days ago, October 28th. But the real story is the immediate follow-up action from analysts.
What happened there?
Well, what's fascinating is this immediate ripple effect. It really confirms institutional confidence. Just yesterday, October 29th, major analysts like Citiuk and Goldman Sachs subsequently raised their price targets based on that strong Q3 performance.
So it's not just a pat on the back.
No, definitely not. It's analysts confirming that the underlying business model execution looks solid enough to justify a higher valuation today. It's a real vote of confidence.
Okay. But maybe the biggest structural news in payments came from PayPal, PYPL.
Ah, yes.
They didn't just raise their annual guidance recently. They took a really definitive step toward, maturity, I guess.
They did. They announced the initiation of a quarterly cash dividend,
Yes.
$0.14 per share.
And this was detailed in their SEC filings, the 10Q and 8K. Why is that dividend announcement, documented right there in those filings, so strategically important?
That is a huge signal change, and the filings make it official,
Yeah.
The 8K is the immediate alert, flags it as materially important. Then the 10Q filing details this new capital allocation strategy, confirming a long-term shift.
So what's the shift?
PayPal is basically saying it's no longer defined purely as a high-growth tech company reinvesting every single dollar back into expansion. They're acknowledging maturity, generating excess cash flow, and choosing to return capital to shareholders. It's really a defining milestone.
Sets a whole new expectation for shareholder returns then.
Absolutely.
Meanwhile, we see the pipeline filling up elsewhere. Robinhood, Aid, opened its Q&A platform, that's through Say Technologies, yesterday. That's for shareholders ahead of their November 5th earnings call.
Getting questions ready.
And Affirm, AFRM, is also seeing positive sort of upbeat estimate changes from analysts ahead of its November 6th earnings.
So yeah, we're seeing a wave of optimism across the sector generally. Well, just as a counterpoint, to keep things grounded, UPST, Square, SQ, Lending Club LC, they had no new major news or SEC filings in this specific 24-hour window. So the energy and attention really remains heavily concentrated on CIN's numbers later today.
Makes sense. Okay, let's pivot now. Real estate tech and auto retail, because this is where the market's punitive mindset, this idea that even great numbers aren't good enough, really comes into sharp focus.
Yes, this is interesting.
Let's talk about CoStar CSGP.
Yeah.
This stock dropped, approximately 15% yesterday?
15%, yeah. And that drop is the puzzle that really summarizes the market's current impatience with these high multiple growth stocks.
Why a puzzle?
Because this severe fall happened despite CoStar reporting robust Q3 revenue growth of 20% year over year. They even released positive commentary on the U.S. office market outlook.
Wait, so analysts essentially punished them for what? Not achieving an even higher, maybe impossible growth metric, 20% growth, and the stock tanks 15%. What does that tell us?
It tells us the market is no longer just buying the story. They are demanding perfection in execution and guidance. Investors are aggressively de-risking at any sign of a future slowdown, even if the present results look strong. The bar is just set incredibly high for names trading at these kinds of multiples.
Wow, okay. Meanwhile, Fannie Mae, FNMA, had a steadier day.
Yeah, pretty steady. Reported a solid Q3 net income, $3.9 billion, filed its 10Q. No real drama there.
Okay, moving to the volatile auto retail space. Carvana, CVNA, gave us that classic mixed result in its Q3 announcement yesterday, post-market.
Yep, a massive beat and a clear miss, all in one report.
So the beat was?
Revenue. Take a smash. The revenue side came in at $5.7 billion, significantly surpassing the $5.1 billion estimate. They sold 44% more retail cars. That's a 55% year-over-year increase in sales volume. Phenomenal execution on scale.
But that scale didn't translate to the expected bottom line.
Correct. Their GAAP EPS of $1.03 missed that $1.30 consensus estimate.
So this is where we see the market's current priority, right?
Right.
Massive volume increase versus a disappointing bottom line.
Exactly. And the stock reaction suggests that right now, the market is aggressively prioritizing margin and profitability over pure volume growth, at least in the used auto sector.
Even though they raised guidance.
They did raise their yearly adjusted EBITDA guidance and highlighted same-day delivery testing in Phoenix as a convenience factor. But that EPS miss just seemed to overshadow the volume win.
That distinction, volume versus profitability, is a critical takeaway for anyone tracking auto retail then.
For sure.
Now, on the negative side, CarMax, KMX, had some genuinely concerning news yesterday.
Yeah, that wasn't good. A law firm launched an investigation into potential securities law violations.
Related to
the company's poor Q2 performance from back in late September.
Ouch. That's a serious headline. Adds regulatory risk to an already tough operating environment for them.
It's definitely an overhang investors will be watching closely.
But on a brighter note, Wayfair W was a clear winner in home goods.
Yes, a clear earnings beat. Both revenue and EPS topped consensus. Predictably, that led to a significant stock jump yesterday. Nice positive story there.
Okay, let's transition now into health. Growth stories here seem to be getting highly specific, sometimes even geographically sensitive. We saw Teladoc, TDOC, release its Q3 earnings yesterday.
Mixed results.
Yeah, but the devil was definitely in the details, wasn't it?
It really was. That mixed result was driven by weakness in their sort of star segment. While the overall results generally met the upper range of their guidance, the critical detail here is their mental health segment, BetterHelp.
What happened with BetterHelp?
Its revenue declined 8%, and that decline significantly impacted overall growth, even though their integrated care revenue, that's their non-mental health service, actually grew 2%.
So the reliance on that specific mental health service seems to be a major headwind right now.
It appears to be, yeah. They filed the related Form 8K to detail all those results.
Okay, contrast that domestic headwind with the international success story we're seeing in medical devices and aesthetics, specifically with Bausch Health, BHC, and its Solta Medical segment.
Yeah, this is fascinating. We're seeing growth driven by very specific, almost geopolitical spending indicators here. BHC reported strong Q3 revenue growth overall, 7%, $2.68, and they successfully converted from a net loss last year to a net income of $179 million this quarter.
Solid turnaround.
Very solid operational turnaround. But the real key nugget for listeners tracking global consumer trends is that the Solta Medical segment grew. Get this. A staggering 25% in Q3.
25%. And that growth wasn't evenly distributed globally, was it?
Precisely. That 25% growth was explicitly driven by high demand in the South Korean market.
Oh, okay.
This confirms that discretionary income for aesthetic devices is surging in specific high-growth Asian markets. It makes it a clear pocket of strength. Really a valuable data point for anyone tracking consumer health spending abroad.
Good insight. And just a reminder, InMode, INMD, which operates in that same aesthetic space. No new news, but they are scheduled for earnings on November 5th.
Right. One to watch next week.
Okay, time to check in on how we entertain ourselves and what we drink. Media and streaming first. There was the finalization of a major deal. FuboTV, Fubo, and Disney Diz.
Yes, they completed the merger of FuboTV with Disney's Hulu plus live TV segment. This is a massive consolidation play in the live TV streaming landscape.
And the key structural detail.
Disney secures about 70% ownership of the combined entity,
Oh.
though it will continue to trade under the Fubo ticker for now.
So Disney getting 70% ownership, what does that practically mean for the remaining Fubo shareholders? Is it still the same company?
Well, it fundamentally changes the risk profile, right?
Okay.
It means the combined company is essentially operating as a subsidiary or, a Disney asset.
Ah.
It's no longer a pure independent startup play. It's strategic direction, it's financial reporting, it's all now inextricably linked to Disney's larger media strategy. That brings stability, sure, but it also kind of caps potential independent upside.
Makes sense. Meanwhile, Warner Bros. Discovery, WBD, is enjoying some significant analyst love recently.
They really are. Analysts are suddenly feeling much more optimistic about that turnaround story. Argus upgraded WBD from hold to a buy rating.
That's a big jump.
And Barrington Research significantly raised its price target yesterday, went from $16 all the way up to $25.
Wow, $25. Those are major positive confidence signals. Indicates a belief that maybe their content strategy and debt reduction efforts are actually paying off.
Seems to be the thinking, yeah.
All right, let's move to consumer beverages. Starbucks, SBUX, and their Q4 earnings from yesterday. Global same-store sales up 1%, China up 2%. Seems okay, but the bottom line told a much more dramatic story.
Oh, it really did. It tells a clear and frankly expensive story of internal restructuring. The GAAP EPS dropped a staggering 85% year over year. 85%, down to just $12.
12 cents. Why so low?
Well, the company clearly stated this severe decrease was attributed largely to restructuring costs, persistent inflation, and significantly the closure of 627 stores.
627 closures. And didn't they say over 90% of those were in North America?
They did.
So that means the flat North American comp sales suddenly feel very expensive, right? With all that one-time cleanup cost hitting the books?
Exactly right. They are streamlining their real estate portfolio, presumably to improve long-term profitability and efficiency, but that process comes with a huge immediate cost. It's a necessary surgical move, perhaps, but definitely painful in the short term.
Okay. On the other side of the beverage market, Celsius, CELH. They filed a Form 144 yesterday.
Yes, that Form 144 is important. It's a notice of proposed sale. It indicates a major shareholder is planning to sell shares, about 2.14 million shares, valued around $135 million.
And why does that matter for a company like Celsius?
Well, for a high-flying growth company like Celsius, this often introduces volatility. While it's not the company itself selling, the market often interprets a major shareholder offloading a big chunk of stock as, well, potentially a negative confidence signal in the near term. Something to watch.
Got it. Okay, let's quickly wrap up with a look at apparel and insurance tech, starting with Lululemon LULU. Big news recently was their first official NFL licensing partnership. All 32 teams, massive exposure.
Massive exposure, absolutely. But the market reaction has been, interestingly, deeply mixed.
Really? Why mixed?
Well, yesterday, Jeffries commented that the NFL partnership was questionable regarding its impact on LULU's premium sort of exclusive brand identity.
Ah, the brand dilution argument.
Exactly. It's a difficult risk-reward trade-off, isn't it? Do you chase mass appeal and volume via the NFL, or do you try to maintain that highly profitable, exclusive aura the brand has cultivated?
And meanwhile, rival Nike, NKE, is clearly focused on a counter strategy.
Seems like it. They're trying to regain lost market share by concentrating on a player-focused storytelling strategy, rather than broad league licensing. Trying to rebuild loyalty at the individual athlete level, perhaps.
Interesting contrast. Okay, finally, insurance tech. Lemonade LMND saw some significant volatility yesterday.
It did. The stock jumped substantially, 11%.
An 11% jump is phenomenal. But there was a catch, wasn't there? Something that made this news kind of complicated for investors.
There was a big catch. Despite that sharp market enthusiasm, Weiss Ratings reaffirmed a sell rating, actually a D rating for LMND yesterday.
Wow. So an 11% jump directly contradicting a reiterated sell rating. How do you even square that circle right before their earnings?
It's a true tug-of-war for investors, isn't it? The jump suggests maybe retail excitement or short-term trading, while the rating reflects ongoing fundamental business concerns. Very tricky.
And we should also note Allstate ALL and Hippo, HIPO, are both scheduled to report Q3 earnings next week, November 5th, so more data coming soon in that space.
Yep, next week will be busy for Insurtech.
So, okay, let's try to synthesize everything we just went through. The defining theme right now really feels like the market versus high expectations.
I think that's fair.
We saw CoStar punished with that 15% drop despite 20% revenue growth. Carvana's huge volume win was overridden by margin disappointment. On the other hand, Solta Medical, a clear winner, seeing 25% growth, but specifically fueled by the South Korean market.
Right, very targeted success.
And the Starbucks earnings told that very clear, very costly story of necessary restructuring hitting a bottom line hard.
Yeah, and if we connect this to the bigger picture, it shows that critical thinking means looking beyond just the revenue headlines and really understanding investor priorities right now.
Which seem to be.
The market is rewarding strong niche execution like Solta in Asia and punishing perceived structural weakness like BetterHelp's declining revenue at Teladoc. We're definitely in a demanding environment where execution needs to be pretty much flawless, and volume no longer seems to excuse weak margins.
It really does feel like the era of growth at any cost is definitively over. Profitability and margin are king.
I think so. And this raises an important question as we look ahead, to the immediate future.
Which is?
Well, with Coinbase reporting today and key insurers like Allstate and Lemonade reporting next week, how will analysts' confidence in these high-growth, high-multiple names like, say, Affirm hold up? Especially if broader macroeconomic factors start hitting the newly optimistic Q3 guidance we've seen this week.
Meaning, will the market accept any misstep at all?
Exactly. Or will we see more CoStar-like reactions where even pretty great news just isn't good enough? That's definitely something for you to consider as this earnings season rolls forward into November.
That sets the stage perfectly for the week ahead. Thanks for guiding us through this necessary deep dive into the numbers.
Anytime. Good talking.